Now I'd like to introduce David Rosenberg, CFO of Textron. Textron's a world leader in business jet, general aviation, helicopter, and tilt-rotor aircraft. The company operates in 5 segments: aviation, Bell Systems, industrial, and e-aviation. Textron has 180 million shares, trades around $80 for a $14.5 billion market cap and $2.5 billion of net debt for a $17 billion enterprise value. We welcome David today. David, please come and we'll chat. Well, it's great to have you back, David. Thank you for coming. Maybe we could just jump right into it. Maybe could you provide an overview of Textron's current operations and key business segments?
Sure. To start off, I think I'll lead off with our largest business, Textron Aviation, which has the Beechcraft and Cessna brands. It's about a $6 billion business, which about 1/3 is aftermarket, which is really the most profitable piece of that overall portfolio. We did have a strike last year, so our revenue was slightly down, but we've seen good growth this year. The market after the pandemic had a very positive paradigm shift. The last decade was very challenged from both a pricing perspective and volume perspective, and since then we've seen very strong pricing, and the company's embarked on a product strategy that's basically one clean sheet and multiple derivatives from a product development perspective, which has been very helpful and driven pricing and volume in our company. So this year we expect to have revenue of about $6 billion, and our range in margin, segment margins, about 12 to 13%. Our next largest segment is Bell Helicopter, which really has had a great year. The most significant event in our overall company this year has been the reaffirmation of the was previously referred to as the FLRAA program, but as the MV-75 program. We've been working with the U.S. government to, in fact, accelerate that program. That, in essence, will be replacing about 4,500 Black Hawk helicopters throughout the world. We think the program in total, at a minimum, could be worth between $80 and $100 billion, and will deliver between 40 and 60 when it gets to rate per year. Right now, we're in the development phase, so booking about $300 million of revenue per quarter, which has been growing every quarter. And since the new administration came in, their focus has been to actually accelerate that program, to get it into service sooner, which we, of course, fully support. So I think there was some concern with the changeover administration of where the FLRAA program stood, and it's been very positive for the company. The Defense Department has been very outspoken in support of the program, and in fact, their goal to accelerate. I'll stick with A&D and then go to our industrial segment. So our last key A&D business is our systems business. Right now, it's about a $1.25 billion business. Very good margins, between 12 and 13%, probably on the high side this year. It's actually made up of multiple subsegments. I'll start with the commercial piece. It actually, our Lycoming piston engine business, which is essentially an aftermarket business, is in that group. Worth about $300 million a year. Very good aftermarket business, not dissimilar to our strong aftermarket business at Bell and Textron Aviation. We want to keep it at systems, though, and not, like, for example, put in Textron Aviation, because it actually services multiple OEMs. We have an air group that does unmanned drones. Previously, the Shadow program, which was ended about 2 years ago by the government. That might have been the first time you and I had a conversation, by the way. And we were competing for what was to replace the Shadow program, the FTUAS program. The government basically told us we won, and then said, oh no, by the way, we're not going forward with the program. So they're rejigging that program right now, so I wouldn't give up hope that that's going to come back. But that basically is featuring kind of our previous, the Shadow program used a drone called the Aerospace 4.7, FTUAS was Aerospace 4.8. We have a weapons systems group that actually I think has a lot of exciting opportunities, particularly around material sciences on reentry vehicles. We're involved in the Sentinel missile program, which is driving a lot of growth. And the important thing about getting involved in that program is actually opened the door for us to a lot of other hypersonic opportunities in the reentry space. So we view that business as a really good growth engine going forward. We also have our marine group, that's our ship-to-shore business, delivering about 4 craft a year, and that business profitability has improved significantly as we've started to get into the lots. An electronic systems group that does a lot of simulation. And then lastly, a business we don't talk a lot about, but we'll probably, you'll start hearing about it a lot more because they've gotten about $1 billion of backlog this quarter, is our ATAC business. That's adversarial air, basically playing the role of the bad guy for flight training. They've won about $1 billion in bookings this quarter, so they're very well positioned for growth as we go forward. So overall, it's a very nice portfolio. Our only challenge has been to drive growth. We thought we had crossed that bridge. I should also have mentioned our land business, which has the ARV program, as well as previously the RCV program, which the government also told us we won and then ended that. But to the team's credit, despite those setbacks, we've still been able to maintain our revenue and margins, and we still think that we're going to start seeing growth. It's just going to be a little more delayed than we hope. In our industrial group, we have 2 commercial businesses. We have Cowtex, which does fuel tanks, both gas fuel tanks, hybrid electric, and has now also entered the space of basic plastic enclosures for batteries. It's a very well-run business, in my view, in a very challenging industry. It actually has one of our better return on invested capital. It does drive a lot of cash flow, but as you know, automotive's been basically flat to going slightly down, so their revenue tracks that. And despite the fact they're going to have lower revenue this year, we expect them to have better profitability. The recent trend of electric basically somewhat flatlining, and a lot of OEMs are going back to hybrid electric, which is kind of in our wheelhouse, has been a real positive for us. And we actually just won our first major pentatonic victory. That's the battery enclosure with VW. So that business has certainly stabilized and is driving good profitability and cash flow. And then TSV, which is largely built around the E-Z-GO golf cart franchise, both for golf courses and then what we refer to as PTVs, which is kind of the recreational use of golf carts. That's probably had a lot of headwinds with where end markets are. The golf side is doing very well, but the PTV business has been hurt, and it's a very profitable piece of the overall TSV portfolio. Has been hurt by the higher interest rates that segment was really, of the consumer, was really affected over the last 3 years, as well as a lot of import pressure, particularly from China. We won a trade action about, I'd say 18 months, we initiated it 18 months ago, but we won it formally about 6 months ago. So over time, that will likely result in a lot less cheap imports coming in. They put about 200% tariffs, the ITC did, as a result of our action. But that sort of has created a lot of headwinds. We were able to divest our power sports business earlier this year that really was adversely affected by the consumer environment. But we're still seeing the end markets challenge. So we're very focused on cost reductions in this segment. And that's what we're going to be continuing to do. So that's kind of top level, I think, of pretty much everything to get us to over $14 billion.
That was a great, very terse overview, David. Thank you. Maybe let's just jump right into aviation. Let's talk about your latest order activity, backlog in aviation, especially following the Q2 results with almost $8 billion backlog there.
Yeah, so we have now roughly 2 years of backlog. The street really tracks our book to bill, as we refer to it, every quarter. I would say it's probably better if you were kind of looking on it on a 12-month basis, because each quarter is very unique. We always talk about business jets, but a big part of our operating model at Textron Aviation is special mission sales, special mission King Air sales, for example. And those come in very large tranches of orders. So some quarters where we get those, you're going to see a spike above one. And if you don't go with those, you might see it slightly below. So you see this kind of lumpiness in our model. Also, we get fractional orders in certain quarters that are bigger than others. But overall, the market's been very steady this year, exactly as we expected it to be. And it's also benefiting from the fact that we have been announcing every year new products. And that always, we have certain light jet models that we announce, which was actually the Gen 3s, the CJ Gen 3s, that you can't get a unit until well into 2028 now. So it's very helpful in driving overall demand and bookings.
Sounds like people want a lot of jets, especially
Yes.
yours. Maybe talk about your how are you managing demand against production capacity? I know Scott talks about that on the quarterly calls heading into the second half of the year and in 2026. How's that look?
So as I mentioned before, we had a strike last year, so we did expect, particularly in the first half of the year, you'd see kind of a ramp of jet deliveries in particular, and it went from 31 jets in Q1 to 49 in Q2. Our special mission King Air airplanes, which is a big overall percent of deliveries this year for King Airs, when you get them out of the factory, you generally have a 3 to 6 month mod cycle. So that's why, but even in Q2, we had much lower King Air deliveries. So you'll see a big ramp of that in the second half. I'd expect you'd see relatively similar deliveries on the jets, Q2 to Q3, and then the big traditional ramp in Q4. Overall, we're still battling through. I mean, supply chain has definitely improved, but you can't deliver a 99% complete airplane. So there's still pockets, and there's not just one thing that come up that do cause challenges. We've seen our retention levels improve with our direct workforce, but we have a lot of early career people coming in. So there's certainly, it takes time for them to get trained up. Usually it's actually 3 to 5 years before you really have an efficient craftsman or craftswoman producing those airplanes. So those are the other challenges we're battling through. So certainly, I will spin one positive. Demand is much greater than supply, and that goes for the whole industry. So we've done, I think, an admirable job of getting our pricing power back to where it needed to be. But we'll certainly continue to just judiciously try to ramp up, but we can't just do a giant spike. The supply chain itself couldn't support it if we tried, and we want to make sure that we're adding labor efficiently and not just putting a bunch of early career people on the factory floor. So we have a training academy now that we've built, and so you usually want to have them there for the first half a year before you put them out on the floor. So year over year, our goal would be to improve production, and we're going to continue to try to do that in a steady fashion, not a big jump up at once.
I know you sort of went through this a little bit just a moment ago, but with this robust order activity, driving the backlog in aviation, maybe you could tease out a little more which market segments are showing the strongest demand signals. And I know you've sort of talked about it overall, but maybe you could just give a little color on where it's looking the best.
Yeah, so I'll start with turboprops, work my way up to jets. Turboprops are the most interesting one because they are serving small business owners, which still remains robust. Our Caravans and Sky Couriers also serve airlines, which has had very good steady demand. The Sky Courier is not just a cargo carrier for FedEx, but it's also a combi where it can do 9 passengers plus cargo. We're seeing good demand for that, and we're starting to see demand for the 19-seat passenger option outside of the United States. And then there'll be a fourth stool there. This is also going to be a very good special mission airplane, so we'll start seeing that demand come in. So overall, the turboprop business continues. All those different verticals have really good demand. On our jet side, our light jets, what really is kind of the core of the Cessna franchise in many ways, driven by new product development, we're seeing excellent demand. I mean, the backlog on those is actually, in most cases, above 2 years, particularly on the next generation CJ3 and CJ4s. M2 continues to do very well. Our newest product, quasi, I'm not going to call it clean sheet, but a very heavy derivative. The XLS is becoming the Ascend, and the introduction of that airplane is going to actually happen this year. So we've seen good demand there, but that's a Part 25 airplane, so you're starting to move up now into the corporates as well as the fractionals, and there's very good demand there. And then we have the Latitude and Longitude, so that's both fractional, very high net worth individuals, and of course corporates. And so demand's been very steady, I'd say, across all of those verticals, with spikes in a good way happening, particularly when new products are introduced.
Very nice. Very, very good review of that. You did talk about pricing. It's remained resilient amid strong demand and expanding backlogs. How do you view, and I guess this might be a little too forward-looking, but pricing dynamics going into 2026? Can Textron sustain these price increases in this environment? Maybe you could talk about the dynamics going on there.
Yeah, and I maybe take one quick step back to talk about dynamics to how we got here. In 2019, you could buy many of our jets for literally, not inflation adjusted, the same price that it cost in 2008 and 2009. So it was low inflation that decade, but our costs are going up 1% to 2.5% a year. The industry had just no pricing power. the paradigm shift that happened in the pandemic, I think our company really led the way on basically getting pricing back to where it should have been. So we've restored that, and you certainly saw very giant, rapid spikes. I mean, in some cases, there are literally models we have today that we're netting $5 to $6 million more on that model today than we were in 2021. So how does that translate going forward? Because certainly pricing has stabilized at a much higher level. We believe we should continue to get what I'd say is a moderate tailwind on pricing as a result of our product development strategies. We announced at NBAA last year, the CJ4 Gen 3 as an example, and the CJ3 Gen 3. And we hadn't even delivered Gen 2s yet, but we had already sold the Gen 2s. And people be like, well, are the Gen 2 customers going to be upset? They're not, because we've raised the pricing at such a higher level on the next gens. And if the customer wants to switch, we'll be more than happy to do it. But a lot of times the customers are happy because they have the quote-unquote cheaper model. So we should be able to get pricing above inflation on most models thanks to our product development strategy. Now, will it be the huge premiums you would have seen in 21 and 22? Of course not. But we were making up for basically close to 15 years of deflation in our industry. So that's a key part of a unique part of our strategy going forward.
Yeah, that's a great review as well, and a good outlook in how things are going to probably play out. What are the current trends that you're seeing maybe in the different markets as far as you talked about the Sky Courier, Caravan, maybe some of the other markets. What other trends are you seeing there?
I would just think it's steady. I mean, one trend people often ask us about is accelerated depreciation. Is that going to be a huge boon for you? It was very important last decade when we actually had whitetails available at an end of the quarter, end of the year. We could go to a customer and say, hey, you can fully depreciate this if you take this airplane right now. Now, of course, with 2 to 3 years of backlog, they don't get that instantaneous gratification with accelerated depreciation. But of course, they would want that in 3 years. So it's certainly not a negative for us. So I think overall the trends remain steady. Obviously the industry had 2.0, in some cases above 2.5 book-to-bills in a couple quarters in 21 and 22. People thought, the world was gonna be a quick sugar high and go back. But no, we're at a higher rate and at a steady rate, which we're very comfortable with. Yeah.
You've talked about a stable rate.
Stable rate.
Lets them order the orders they want to do in the timeline they need.
Yeah. And we're showing this year we expect to have about 5% aftermarket growth, which is key, supported by pricing, as well as you continue to see flight hours are ticking up overall in the industry, which is an important leading indicator.
Very good. All right. All right, enough of aviation. Let's switch to the main event here. Bell, following Milestone B approval in 2024 and the delivery of the first MV, now named MV-75, virtual prototype just this past June. What's the updated outlook for the MV-75 program, maybe including timelines and prototypes for the first flights and the LRIPs, sort of the LRIP rates going up?
So the way the original program was configured is they were going to have 6 prototype units, which basically came with Milestone B, 2 limited user test units that were also exercised. And actually then there was going to be somewhat of a production gap. And then you were going to have 8 fixed-priced LRIP units. What acceleration means is, first of all, closing that production gap, which is very important from a efficiency perspective. But then secondly, likely increasing the overall LRIP lot, which will be very helpful for us in terms of buying long lead material, negotiating with suppliers. What is publicly out there now from the Department of Defense in some interviews is so they'll take LRIP 8 and then they'll have 2 other LRIPs of 12 and 20. So that would all be progressing through this decade, which then gets us to the most important point of where this program really starts driving margin and profitability for the company. You start getting into the first lots of production after that. And we do cost to cost. So even if the first lots actually delivered in the early 2030s, when you start bringing in material and working on them, you'll be able to book revenue and profit for that. So I think those are kind of the major events. Now, we got some additional funding from the Big Beautiful Bill, excuse me, that supports that. And then as we look at the FY 27 and 28 budgets, really funding that will be key. But the government's being very supportive in our acceleration efforts. You know, there's some non-monetary things that really help as well. You know, I'd classify under, bureaucracy and such that we've been able to clear out that have really helped us. And you see it in the numbers. I mean, we're working more and in a more accelerated fashion, and you're seeing us kind of go at that $300 million pace and now potentially passing it on the quarterly revenue from the program.
Could you just, I just want to make sure I'm clear, the the transition from cost plus to the fixed price, how could you sort of walk through how that will work again and how the profitability sort of changes there?
Yeah, so this is somewhat of an oversimplification because there are many different kind of CLINs or, in essence, work orders in this program. But the one piece that is fixed price in the initial program is the 8 LRIP units. So that's always been a particular area of concern for the investor community, just because other companies, and this is very common, the defense industry has been involved in fixed price defense programs, these LRIP units have resulted in significant charges. The other work right now generally is cost plus, low single-digit margin cost plus, but cost plus nonetheless. So we've been getting appropriately, well, a lot of concern from the SC community. When are you going to take charges or such related to those LRIP units? Now, first of all, we're not sure there's going to be charges or not charges. The trigger points generally are when these CLINs are exercised. But the point that we've been trying to make to the street, and you know, this did come up somewhat on the Q2 earnings call, is all these actions for the government and acceleration actually de-risk what those charges could be. And I'd also remind you, you know, and this is just, say that each helicopter is about $100 million, okay? And that's an oversimplification. That's significantly less than, say, what one stealth nuclear bomber is. So from a relativity perspective, we're not talking about that. So things will start, my job, I think, in telling the Flowers story, our job of telling the MV-75 story is going to become a lot easier as this stuff gets definitized, and so I don't have to talk in gross hypotheticals, because I think that's what's caused a little bit of the uncertainty in the investor community. Just one other point to add, we're conservative in how we do our booking rates for the program, so, you know, trying to build up management reserves so we can avoid these giant surprises. But in my view, everything that's happened in the last couple of months has de-risked the program, not increased the risk.
And just me crystal clear, is that's just simply because the view that production, you know, operating leverage is going to be, you're getting more production operating leverage out of the higher production rates in near term.
Well, also those fixed price LRIP units, yeah. You know, after I built that last limited user test airplane, which is Unit 8, I want to be able to immediately start working on Unit 9. If there was a 15 huge gap, I lose huge efficiency. And then if I can go out to suppliers and negotiate for 40 or 50 ship sets of whatever they build, that's hugely different than trying to negotiate for 8. So this is all positive.
Maybe I could throw one more in here with MV. Just maybe talk about, you know, we went to the Paris Air Show this year, saw you there, had a great discussion. Just international, any updates, changes with international orders, views, thoughts on that?
There will be significant orders for the MV-75. It'll be, of course, up to the Army when they are willing to kind of shift some of that production capacity to what would almost certainly be FMS sales with NATO allies. But they're already involved, the Netherlands, the United Kingdom, in looking at this product.
They all want it. It's just who can get it is based on your your production rates.
Yeah, I mean, we're going to have to ramp up at 40, 60 units, which, you know, I'm sure in the modern manufacturing in the United States will probably take a little longer than we'd like. But, you know, certainly I think the opportunity is significant for this program when we get there.
And then maybe just now finishing up here with Bell, let's talk about legacy. I know you guys don't discuss this much, but just, you know, their military business with the V-22 and H-1, just production over the next few years, and any developments that have gone on there, just this, you know, the legacy programs you could talk about.
So V-22 production's basically ending, probably final delivery in 27. H-1 production is actually picking up a little bit now because of a Nigeria order. Those are two, in essence, offset, and behind that is a huge aftermarket business that's going to be an annuity for our company for the next 20 plus years. So I would describe that business to you over the next 2 to 3 years as being steady, profitably steady. So but it's also a very important long-term positive for Bell. That will help us as we, continue to go forward and invest in FLRAA.
What about the commercial side of Bell? I know we didn't talk much about that, but maybe a quick, obviously a lot of stuff's going on in oil and gas and just views there.
The market's really good. I mean, to put in perspective, it's about a 1 year worth of backlog that we have in that side of the business. Our production capacity, similar we see in Textron Aviation, we'd like to build more, but it's probably going to be relatively steady this year versus last year. But demand across the board is very good. Oil and gas, our big entry into that space will be the 525, and we're working to get certification with the FAA for that. That market certainly is in a replacement cycle right now, replacing the S-92 from Sikorsky. So, overall, I'd say the market conditions are positive with about a 1 year backlog, which I don't think is very atypical for the helicopter segment versus what we're seeing in GA of 2 to 3 years of backlog.
Okay. Maybe we'll switch it to systems here, and I'll open up the floor to the audience. What key growth opportunities do you see at Textron Systems heading into 2026? I know you gave us sort of a brief overview, but where are you really focused in the systems business?
So we'll see growth in ATAC. I think we're going to see growth in our weapons business around the Sentinel program. I think you will potentially see growth for some of these programs that we bid on, won, and then didn't win. That's around RCV and FTUAS. They'll be called something different, but the products behind them, I think, will drive growth. Our electronic systems, our simulator business is also going to grow. And as the ship-to-shore business continues to stabilize, revenue's probably not going to grow significantly, but profitability is. So overall, the key is going to be to win a couple of these programs. They're relatively small, but that will, plus growth in our legacy business, like on the Sentinel program, should get Bell out of this $1.25 billion kind of flat line that we've been in the last couple of years.
I'd like to open the floor up to the audience. Mariel.
I'm going to have to yell it out. How much did you lose? What are the cash flow implications in 2025, 6, 7 for the MV-75? Are you negative cash flow by ship set and in the aggregate, and how does that go down when the street talks to you?
So the biggest cash flow impact is with acceleration. We will likely accelerate CapEx, equipment spending, as well as material spending, what would have been, say, in 28 and 29 into 26 and 27. So that will be a delta to what we would have originally expected. But here's the good news. The tax bill that passed is very significant in that it's going to help us. It's going to significantly lower our cash tax payments. So that'll be a very nice offset to the additional investment we're going to have to make at Bell.
Have you given any specific numbers on that? Because it's not a book tax. Your effective book tax is unched, but
Right.
it's a cash taxes benefit, right?
Yeah. We
So
said
that still has an impact on your EPS, though.
So we said this year the cash benefit's going to be about $100 million, which we think actually could be higher going forward. We are going to have a negative ETR impact in Q3 because the irony is while we're paying less cash taxes, the deductibility of certain foreign tax credits for this year kind of will go away. So it was probably about a $30 million EPS impact, which we absorbed in our guidance, with the biggest impact being in Q3. So we had guided this year, roughly 18 to 20% taxes, and we're going to end up between 20 and 21%. So, but it's only a short-term impact. Most of the rest of the tax bill is significantly positive.
Maybe before. Oh.
You mentioned that you sold off the power sports division here earlier. Any future M&A opportunities for you guys, you think, with the way the industry is right now, or even kind of selling off any of the less profitable segments at this point?
We've been very open in the past to looking at opportunities in the industrial business to divest them. The biggest problem with Kautex is while A&D multiples are great right now, industrial multiples aren't. The offer we got for Kautex was less than 3 times cash flow. And we just don't think that drives value to our shareholders. as I said, it has a very positive ROIC, and it is producing a lot of cash, which we are using, obviously, to buy back shares. But we would never reject if an opportunity came up in the industrial business with appropriate value to move it. We have always looked at A&D opportunities. The challenge remains, how do you pay such a high multiple versus, you know, what I think has been a very successful share repurchase program. So we certainly are aware of what's going on in the market, observing, but you know, I think our priority on capital right now is going to be share repurchase.
Okay, David, I think we've peppered you long enough today. You did a great job. Thank you for coming, and hope to get you back next year.
Absolutely.
Great job.
Thank you so much.
Thank you.
Tony Bancroft is a portfolio manager for Gabelli Commercial Aerospace and Defense ETF. Michael Bergio and Daniel Gleam are research analysts at Gabelli Funds. The above webcast is a recording from the 31st Annual Gabelli Aerospace and Defense Symposium, which occurred on September 4, 2025. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of June 30, 2025, affiliates of GAMCO Investors Incorporated beneficially owned 5.61% of Abdu Komen, 2.98% of Graham Corporation, 2.41% of Astrotics Class A and less than 1% of Class B, 2.37% of Moog Class A and less than 1% of Class B, 1.38% of Textron, and less than 1% of all other companies mentioned. The analysts' views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other GAMCO officers, analysts, other employees, or of the firm as a whole. Because the investment personnel at GAMCO and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain GAMCO personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800-GABELLI 800-422-355-4914, 921-5100, fax 914-921-5118, info@gabelli.com. Tony Bancroft is a portfolio manager for the Gabelli Commercial Aerospace and Defense Fund. This ETF is different from traditional ETFs. Unlike traditional ETFs, this ETF will not tell the public what assets they hold each day. This may create additional risks for your investment. For example, you may have to pay more money to trade the ETF's shares. This ETF will provide less information to traders, who tend to charge more for trades when they have less information. The price you pay to buy ETF shares on an exchange may not match the value of the ETF's portfolio. The same is true when you sell shares. These price differences may be greater for this ETF compared to other ETFs because it provides less information to traders. These additional risks may be even greater in bad or uncertain market conditions. The differences between this ETF and other ETFs may also have advantages. By keeping certain information about the ETF secret, this ETF may face less risk that other traders can predict or copy its investment strategy. This may improve the ETF's performance if other traders are able to copy or predict an ETF's investment strategy. However, this may hurt the ETF's performance. For additional information regarding the unique attributes and risks of this ETF, see the Non-Transparent Exchange-Traded Fund, ETF, Structure Risk, Early Close/Trading Halt Risk, and Authorized Participant and AP Representative Concentration Risk in the Principal Risks section of the prospectus. Exchange-traded funds, ETFs, are bought and sold through exchanges trading at market price, not NAV, and are not individually redeemed from the fund. shares may trade at a premium or a discount to their NAV in the secondary market. There is no guarantee the investment strategy will be successful. Investing involves risk, including the possible loss of principal. Premiums or discounts are the differences, expressed as a percentage, between the NAV and market price of an ETF on a given day, generally at the time the NAV is calculated. A premium is the amount an ETF is trading above the reported NAV, expressed as a percentage of the NAV. A discount is the amount an ETF is trading below the reported NAV, expressed as a percentage of the NAV. The prospectus/registration statement shows the frequency of distributions of premiums and discounts for these ETFs for the most recently completed fiscal calendar year and all completed quarters of the current fiscal year. Investors should carefully consider the investment objectives, risks, charges and expenses of the ETF before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 800 Gabelli or visit www.gabelli.com. Risks to the ETF include a downturn in commercial air travel, production and/or supply chain disruptions, decreases in defense spending, subcontractor financial health, and competition and/or technology changes. As of June 30, 2025, the common stocks of Boeing, Ducommun, Curtiss-Wright, Moog, 5.55%, 4.54%, 4.26%, 3.69% of the fund's net assets, respectively. As of June 30, 2025, affiliates of Gamco Investors Incorporated beneficially owned 5.61% of Ducommun, 2.98% of Graham Corporation, 2.41% of Astronics Class A and less than 1% of Class B, 2.37% of Moog, Class A and less than 1% of Class B, 1.38% of Textron, and less than 1% of all other companies mentioned. Distributed by G. Distributors, LLC, a registered broker-dealer and member of FINRA.